I think if people are unfamiliar with history, I've seen, for example, a lot of pundits, a lot of policymakers, a lot of analysts calling this period unprecedented. That's a word we've heard a lot over the past couple of years, whereas people that are familiar with financial history would consider this anything but unprecedented. It's just that the precedents, the closest precedents, are not really within our lifetimes, or at least our adult lifetimes for some of the older followers of markets. And so we have to go back essentially to the 1940s to find a similar environment. And that quote that's either accurately or inaccurately given to Mark Twain, basically the one that goes like, history doesn't repeat, but it rhymes, I think is the closest way to think about this. There's no period in history we can say, okay, here's how it happened, and so here's how it's going to happen again. It's saying, okay, here's a period in history, what happened there, why was it interesting, how is it similar to the current environment? How can it kind of give us some sort of outline? But then also, what are the differences between now and then? And therefore, what are the most likely areas of deviation from then? And the reason I use the 1940s is because that was essentially the last time we had, this kind of 1-2 punch of a popping private debt bubble, which was in the 1929 crash, and then into the 30s we had a collapsing private debt bubble. Interest rates hit zero for the first time in a long time, and then we started to get rising populism, and then that rising populism contributed to global war, which then resulted in a huge fiscal response. And so the 40s, after disinflation in 1930s, the 40s were very inflationary. And that money creation wasn't from bank lending, it was from fiscal spending and, the central bank monetizing that spending. And so if people ask, I got the question before, if I didn't know there was a virus and I just looked at charts today, what would I think is happening? I would describe it as wartime finance. That basically, we had a similar popping of a private debt bubble in 2008, 2009. Then we had a decade of relative stagnation. It wasn't as bad, obviously, as 1930s. Different technology, different monetary policy, no Dust Bowl, obviously. There are a lot of differences. We had this kind of stagnating period, rising populism, and then, of course, we were hit by the pandemic. We had a war-like fiscal response to it, and then now we actually have the breakout of some degree of kinetic war. And so I view the 1940s as the closest parallel. It's also the only time in U.S. history where sovereign debt as a percentage of the economy is as high as it is now. And so we saw a very different response to that inflation from the central bank compared to what we saw in the 70s. And so overall, I think that's the closest environment. There are some differences, though. So, for example, back then, the United States was kind of in China's position. It was this rising emerging market. We were a net exporter. And so in many ways, the United States looks more like the UK did in the 1940s, if we were to be more precise with that analogy. Then even then, of course, there are multiple technology differences, demographics differences, structural differences that make this period different. And when people think of inflation, they often think of the 70s. And that's the one that I try to somewhat shy people away from, because in the 70s, that inflation was very much driven by bank lending and demographics. Basically, the baby boomers were entering their home buying years. And so you had a ton of building construction, you had a lot of bank lending. That's where a lot of the money supply growth is coming from. Of course, there was a fiscal overlay on top of that, the whole guns and butter program. And so that was a very inflationary environment. The one, but it was different. So they were, debt was low. They were able to raise rates to deal with it. Just a very different environment than the 40s and that we have today. The one thing I think we can really get out of the 70s, though, is the energy situation. So in the 1970s, domestic U.S. oil production peaked in 1970. After about a century of persistent growth, it peaked in 1970. So you had that money supply growth and that demand growth combined with a very real supply constraint. And so the United States became more reliant on foreign imports, obviously. That opened us up to geopolitical risk and scarcity. And so I'm finding a similar environment today where energy is the bottleneck for a variety of reasons. But then the monetary and fiscal side looks generally more like the 40s than the 70s. And again, these roadmaps are not perfect, but I feel like, if people are unfamiliar with history and are unable to identify the similarities and differences between those periods, then they're kind of totally flying blind, and they're going to view a lot of things as unprecedented and confusing when we have examples of history that we should at least be aware of to help guide us.
Now, there's another interesting aspect of this, Lyn, talk about 40s and the 70s, which is there was a structural change in the way the monetary system worked once we got off the gold standard. And I do wonder if that factors into any of these types of analogies with the 40s, Because even though everything you mentioned, of course, is unequivocally true, and there are parallels there, that seems like it's a pretty big differentiator to even understand that make that terrain parallel, so to speak.
The main one that changed there was the structural trade deficit situation. So I factor that heavily into my analysis as it pertains to this current eurodollar petrodollar system compared to the Bretton Woods gold standard system, because now the treasury is at the heart of the global financial system rather than gold. That's the biggest difference. And so that's been a strong catalyst to force the U.S. to run these structural trade deficits and to have these, the positive flow of foreign capital into U.S. markets. And then our subsequent reliance on that engine continuing, and the harms that come from having that engine continue, because it's not a purely one-way street. Basically, we draw down our manufacturing base to some degree in order to have these stronger capital markets, which is, I think, a contributor to the rising populism that we're seeing today. Going back to the Bretton Woods system, although that was a large change, one thing I would actually argue is that the financial system changed substantially decades prior to that. And that was actually the more fundamental change. So by the time you got to the 50s and 60s, for example, even though the U.S. was officially still on this international gold standard, gold was not a constraint for bank lending. So money supply was growing dramatically, despite the fact that gold in the vaults of the Treasury was, declining that whole time. They're basically banks that they never had a pile of gold that they checked and said, "Do you have enough gold before you can make this loan?" They didn't have that constraint at all. So you already had a complete separation from the whole process of money creation and gold, and that got marked to market in the 1970s, but that was already decoupled for decades leading up to them. Whereas I think the more fundamental changes happened decades earlier when you moved from free banking to central banking, and then increasingly abstracted the gold away from the whole process. So gold went from the banks to the central bank, and then went from the central bank to the Treasury, and it just got removed from the whole money creation process, even when we were still on a gold standard. And that's part of the reason why we ultimately lost the gold standard, is because the gold was no longer a practical constraint on money creation. Even the foreign sector, foreign central banks could create dollars essentially by lending. And that's, the whole eurodollar market grew around the gold market. And so you had this increasing number of dollars and foreign claims on dollars, and those were foreign claims on gold. And eventually the United States severed that connection. So that was just marking to market a problem that was already in place for the, pretty much the whole duration of the Bretton Woods system. That's an important distinction, especially as it relates to the differences in trade deficits between the United States and the UK. Like I said before, I think the United States looks more like the UK from the 1940s than it looks like the United States from the 1940s. So it factors in that way, but I don't think it really factors too much into the monetary and fiscal